The oil markets have been crazy recently. How do I make sense of it all?
There have been many crises, but this is unprecedented to begin with. It's not like you should know something. And as a trader in particular, it's been very difficult. At least 20-30% increases and then 20-30% decreases in a day. That's enough for people to make their year and then lose their year and blow up in one day. If you've been in the outright price, I'd be incredibly surprised if you've made money. You're hearing about oil traders in the market having huge margin calls, but these businesses are like $10 to $15 billion a year businesses, and they're getting margin called. It's all about WhatsApp these days. It's blaring all the time. You're forming camaraderie like it would be in battle. We were like, okay, so we could just lose $1 billion.
Greg, thank you so much for coming on the pod.
Thanks very much for having me. Big fan of your podcast.
The oil markets have been crazy recently. How do I make sense of it all?
I would honestly argue to begin with, it's not like you should know something. And as a trader in particular, it's been very, very difficult because, from the one hand, you had the shock of the crisis and kind of a lot of things this year, and you can trade that. But I think what has been crazy, particularly in the last week, as in this week just gone, was that it really ramped up a notch, and the market has behaved in such a berserk way. There's so many dislocations that it's just a fight to get any liquidity at all. And again, there's so many oil contracts out there and different liquidity pools out there, and Brent and WTI, these key contracts that probably a lot of traders or finance people know. That's really the pool of liquidity that people dip into to hedge. But even that market, that's super liquid usually, and the basis for a lot of these hedges is completely broke down. So for us, we're used to at least 1 or 2, 3 cents bid offer, deep liquidity, lots of high frequency traders, all that kind of stuff. We're talking like 50 cents per barrel bid offers minimum, and like the price swings as you're hedging, you're talking like dollars per barrel at a time. And it just breaks the whole system because so many things in the oil world in terms of their contracts, all the contracts for every different product around the world, every different region, all ultimately links back to these core liquidity pools. But when everything is broken from that sense, it's incredibly hard to get a handle on it. So really, speculations to some extent been out of the water. It's been very, very difficult to do. We know that a lot of funds piled in quite early doors into the announcements, as you probably should, right? I mean, this is quite a binary outcome. But it's been widely reported, the biggest oil swing, not the oil kind of price increase, but oil swing we've ever seen. So, way up to, I think I can't even think about the numbers right now, but, kind of 80-ish up to 120, back down to in a day. So, in that time, I mean, you're talking about, at least 20-30% increases and then 20-30% decreases in a day. That's enough for people to make their year and then lose their year and blow up in one day. And to be honest with you, that did happen. I mean, we're quite well connected in the oil world in terms of the participants and who's doing what, and people getting the tap on the shoulder literally Monday morning off the back of that kind of volatility, and certainly throughout the week. It's just been incredibly difficult from a process point of view. So having said that, this is the danger of going in and trading Brent or WTI just as an outright, oil price, because it's just an indication, it's just a proxy. And as I say, it's like a liquidity pool, but really the what's going on in the physical market gets reflected in these more niche contracts, of which there's many, many, many more, but they're less liquid. And that's our speciality. And unless you've had exposure to those, it's probably been very difficult to get an accurate reflection of what you should really be trading to profit from this. So to give an example, you probably can access time spreads at some of the bigger brokers, Brent time spreads, WTI time spreads. That was the closest you were going to get to a good binary, buy goes up. Yes, it's volatile, but you make money. If you've been in the outright price, I'd be incredibly surprised if you've made money. So it's as simple as that, really, just to start off with.
So you mentioned there, you can't really make sense of it. This has been the most tumultuous time you've ever seen, or at least one of them. If you can't make sense of it, and as you've said, process becomes a lot harder because there's so much noise involved, what are the parts of the process, call it the oil trading process, someone like you would look at where you can say, okay, this is within my control And within here, I can see pockets of opportunity where I'm not losing my footing. I know what I can do, and I can make money off of these different dislocations around.
So we are market makers, right? There's obviously a proprietary element to that, as you and your audience know very well. So the temptation was to, and it always is, to combine your market making, look for some arbitrage type opportunities, and then layer that on top of that, just some discretionary element, and ride momentum, things like that. I think to begin with, it was just to really get to grips with you got to take that discretionary overlay off the table. It just doesn't serve you, because you've got people defaulting, you've got people who can't finance their positions. So I'm just repeating myself, but it can't be sensible, because there are people who just, their only job is to take risk off the table because they've either blown up or they just need to hedge, and there's just not really, it's not really an orderly move. So you go back to your core business model, and look, all the high frequency traders, it looks like they've just been out of the game. To some extent, I'm sure maybe in the last couple of days they've been back in, bits and pieces, but certainly not anywhere near the kind of medium frequency trading they usually do. That's been blown out of the water, and you can just see that obviously with the volatility. So you've got to go back to your core model, and if the core model is even suitable for that regime. So I think, as I say, discretionary overlay, it's just not. So the hedge funds are just not going to fare well in this scenario. Maybe increasingly now, but I think at the beginning certainly not. So we just go back to our liquidity providing concept. So what are we looking to do there? Well, it's just a race for fair value. I mean, that's a lot of what we do. You've got the Brent WTI, and you got to go through Europe, Mediterranean, even different areas in the US, Singapore, and for every single product there's that contract. And so there's just so many variations and so many time spreads. Your priority number one is just get a sense of fair value. And if you can be on top of that, and look, everyone knows that, but it doesn't, like any model you had, any automation you had, it just doesn't mean anything in this market. You've got to go back to manual. You've got to be fully on top of it. And it's kind of basic in its process, in the sense, you have a month one price, you add your time spread, and you infer the rest of the curve. And then you can keep adding differentials. And that I don't think is too hard to see how to do. But they're all moving so aggressively, and to keep everything in line, just that alone is 90% of what we focused on. Because then what you're able to do by being like that is obviously spot the things that are just so far offside. You can take it on, and it's not about holding it for a proprietary view. It's about holding it to back out of the liquidity with something you usually do, a correlated contract, or something that can be traded a bit further down the forward curve. So just going back to basics like that, fair value, and just trading what's in front of you, that's what you got to do. Like we started on Sunday night, so Sunday night's 10 p.m. start for us, and that's the Asians coming in, but it's everyone was obviously watching at that time. It gaps up, it's going nuts, but then immediately you get client orders. So we have client flow, we have bilateral business, we have people relying on us, right, as the largest liquidity provider in oil, right? So they're like, where are you on this, where are you on that? You can't just say no price. So you've got to just give your best indication of where you think it's going, where you think you can handle it. And the interesting thing I would say on top of that is, it's just about starting the trade in a way, so starting the process, because you obviously are shocked. And some of our younger guys just kind of bit rabbit in the headlights maybe. And so it's great when a client gives you maybe a bit more of a vanilla order. You get a few indications and you do your first trade, and you kind of hold it in something relatively stable-ish for the conditions. And then you're going, right? Then you're flying. And I think that's what it was. So to get these initial client orders of people being like, look, I just need to get out, or I want to speculate, I want to get long. Like we had a pretty considerable order early on, and a few orders throughout the night, and it really helps you get a leg up, to be honest. And this is where, not trying to toot Onyx's horn at all, but what I'm most proud of is in every other crisis in the past, and as we've been building up, it is much more of a proprietary element. But as you build infrastructure and you build a brand for liquidity, and people are coming to you and you're reliable, this is when it pays off, right? Because they're not really looking for a good economical price. They're looking just for liquidity, and it's what we do. So it was a good test of our business model. But as I'm saying, it kind of helped that they were straight in and we were straight in the game, and we got on the front foot and went from there. If you didn't have that, I mean, to be honest, the only move was to stay out of it until you could spot something not obvious, but you felt relatively safe. But it was just very, very dangerous to do. And even the momentum strategies, right? People say, well, this is momentum's got to be great. Yeah, sure. Intraday swing trading, even a bit of technical trading, believe it or not. You may have fared okay doing that, but it had to be intraday. It had to be, short time periods. As soon as you get anywhere close to half a day, it's just too whippy. Every single model, every single historical analysis would just break down.
I want to go back to that Sunday night. You're not sure what fair value is. How do you even begin to analyze that? How do you even begin to come up with a price when, like you said, this has not happened ever before?
Well, I guess breaking it down, you have the Friday night indications, right? And it's our job to be completely 100% in the know. It cannot be partially in the know. So I guess the moat we've got is our relationship with the brokerage firms around the world and the dark pool of liquidity. To some extent, we've got great visibility over. I mean, it's not like other markets where it's all electronic. It's barely electronic. And in a time like now, it's basically electronic trading goes out the window, apart from, of course, the core one or two contracts. So this is where the niche expertise comes in. So I would say that the number one thing is, okay, you did know where it was Friday night. It's not going to be completely irrelevant. You at least got your starting point. We've also got traders who've thankfully been doing this long enough that they do have a general sense of the relationship between the big moves in the outright contracts, the WTI and Brent and Middle East wars, and generally speaking, what should happen to the refined products, how the curve should behave, how time structure should behave, how clients tend to behave. And if you're in our game and you've got the kind of market share we do, 20, 30%, sometimes 50% of some of these contracts, you've got a very good sense of how people are positioned. So you know the weak spots in the curve, the strong parts in the curve, and that's not going to change really, because at the very least, people are going to sell what they own and they're going to buy what they don't own. So you at least know where those things are going to come in. So I would say it becomes about having a very good feel for how the curvature started and how the relationships were working before, overlaid with what you know. And you should be analyzing these things, right? You've got a weekend, thankfully, in oil where nothing trades. You can use that time to look at previous times of what's happened. So, for example, it's getting a little bit niche, but naphtha, for example, what we use for cracking to make petrochemicals, that is like a really key contract with Iran. They just produce so much of it and they send a lot of it to China. China make a lot of petrochemicals. So for example, that is a real sweet spot for Iran when an Iran situation kicks off. So you're expecting a reaction there. But then you're expecting, okay, if all these things were to get higher, we know the behavior of, say, refiners are going to change. And I guess that's the other thing about this market that is different to maybe even every other asset class. It's just so, in a way relatively illiquid, but so sophisticated. And what that means is, contracts for most things around the world, when there's a big price move of any kind of differential time spread, let alone the outright price, it can reveal economics like very quickly for someone or destroy someone's economics very quickly. And what I mean by that is, so for example, a refiner is saying, okay, I've got to hedge what I produce versus what I buy, what we call the margin. So they're selling this kind of diff. And if it suddenly goes up $5, they've made, like on paper for the rest of the year, some of these bigger refiners maybe made an extra $5 billion. So they're going to want to lock that in. So their behavior changes at these certain price levels. The producers change their activity. And again, going from $80 to $120 oil, you've just gone from maybe pretty good economics for a producing country to suddenly being the best budget they've had for 5 years. So if they can lock that in, that's what they're going to do. And I've got to say, we've never seen, another thing that's unprecedented is seeing how involved governments and producing countries have been in the futures market. Usually they've said, look, it's not big enough, we're too big, we don't want to hedge everything, it would just mess things up. But we saw the US Treasury sell WTI, or at least it was reported that way, selling WTI swaps throughout the year for the year, 11 million barrels, which isn't a huge amount, but in a market like this, it's huge. So again, like a US Treasury coming out and doing that, you've got Saudi Aramco's, the BP's, the Shells, these guys who own a lot of the oil infrastructure in the world, they're hedging. So it's like, in real time, you're seeing their economics change, them trying to lock it in on paper, suddenly those economics flipping on its head and deteriorating, and then the reverse. Shipping companies being like, look, this is great for my economics. Airlines have done incredibly well from their hedges because they're long, right? And they're very active hedges, and suddenly their hedges are way in the money. they're going to want to lock it in. They're going to want to do things that, and for example, actually the airline's a good example, because if they hedge, then that's because they're predetermined travel and all that kind of stuff and fuel usage. So that's what's determined the size of their hedge. So suddenly the price skyrockets as much as it does, and then you have disruption for airlines like that, overnight. And there's been reports of like 1,000 flights cancelled around the Middle East, like per day, these kind of thing. Then suddenly they don't have that physical consumption anymore. So they go, well, we've just got a long position then. We're just speculators now. So they go and rush to take profit. So like the jet fuel market in particular, I've got to say, that was the one that got most of the talk in our game. And there was some serious blood in the streets, but actually it found its way a bit on X and stuff like that, if you guys want to check it out, because that went in a straight line from probably about 100, let me think about this accurately, probably about $90 per barrel, I'd say, because it's got a premium to Brent. So let's just say, for example, $10, $15 above Brent, it just goes bang. And when I say bang, I mean no trades, right all the way up to $200. And then messing around since. So how can that happen? Well, it's an example of the market was so unbelievably short that trade, taking on airline trades, kind of thinking the market's not too volatile, I'll just wear this as a carry trade. Then bang, some of the biggest oil traders in the world have the biggest position on. They can't just go and buy that back. If they buy it back, it's probably going to move another $100 per barrel, maybe even more. So they just have to wear it. And so, you're hearing about oil traders in the market having huge margin calls, but these businesses are like $10 to $15 billion a year businesses, and they're getting margin called. Yeah, this is the kind of craziness I'm talking about. This is obviously a lot of ramble, but you can see how much is going on.
Oh, it's ridiculous. And you touched on a lot there, but the thing I really want to zero in on is how can one build up this mental picture of, how all these different participants within the market are behaving. So let's put ourselves in the shoes of someone who's speculating on airline stocks. And obviously there are so many intricacies involved in the way those businesses operate and their ties to jet fuel, as an example, right? What would you be thinking in that moment on how to navigate something like this?
So this is in the example of an investor. It's incredibly crazy. I guess you would, if you're relating it to airline stocks, it's good to know, particularly for airline stocks, what their hedging program is. And they do put this on their quarterly reports. You do have a good sense of it. And it's probably boring for most of the year, most of the times, but you want to know, because in times like this, it matters a great deal, right? So I guess that kind of foreknowledge is important. But having said that, this is the job of the banks who finance these hedges. This is the job of the market to absorb that risk in an intelligent way. It's not really anything you could have done about that scenario from an airline point of view. So the flip side to what I'm saying is, well, how would you know that the market's taken on all this jet fuel and is positioned that way? Well, that's visibility. And that's something that's going to take a while to come to the oil markets. And it's something we're trying to do our bit on, because we actually sell our data, because we do so many of the trades. What it effectively becomes is the inverse of the market's position. So we sell back that data and information about what the market's doing, right? And that's the best bet you're going to get from a data perspective. But there isn't going to be any alternative to being plugged into every single thing. Now that's a market maker's job. And why is it so incredibly difficult to replicate and do yourself? Well, because it's still got some very interesting dynamics in oil, like, for example, interdealer brokers and voice brokers. And people, when they hear that, say, what, there's voice brokers? I'm like, yeah, there's 80% of the volume is through voice brokers. If they don't know you, if they don't like you, if they don't give you information about who's, or not even who, just what is buying and selling, you're just in the dark, literally a dark pool, right? And that's what the exchanges hate. But it's a very well protected industry, because it's a community. And these guys, yeah, they get paid a ton of money, to be honest with you. But then there's huge companies that see the edge in having relationship with these brokers and probably keeping it that way, to be honest with you. So unless you're plugged into that game, it's going to be very, very, very difficult to have the kind of visibility I'm talking about who's positioned where. And then you could say, well, look, I've got some friends, I've got some good information, but that's classic. We laugh about it all the time. There used to be a thing about go to the pub, basically, a Mayfair pub, and talk about who's doing what. But the whole time they're talking their book, right? And unbelievably, people still fall for the stuff. They go, oh, I know this guy at this company. He said everyone's buying. It's going to be bullish. He's probably on the offer. You cannot rely on that information whatsoever. And people talking their books. I mean, we've gone from traders talking to their books to OPEC talking their book. They're always out in the market feeding information. They know the headline sensitivity. Now you've got Trump talking the US book. It's actually crazy. It's like the financial market. It's so financialized. And I think the worlds and the governments know that and are more familiar with that more than ever before. And therefore they use it, right? They spoof the market, they feed information, see how it reacts. And that adds another layer to this, which you could say, to my point, you need all this visibility with brokers. Well, actually, in that sense, there's been scenarios where huge option trades are going through the night before Iran kicks off. I mean, we're talking huge, huge, huge. Someone clearly knows something, right? And even Polymarket's been pretty useful. Something's kicking off in Polymarket and an event that will clearly have a big impact on oil. And there is an area now, like a dark area of oil, where you're saying, someone might come in and do something pretty serious now. And it's not the oil traders. It's not people with the physical information. It's people with government information. And what do you do with that? So the dynamics are getting super interesting, but like any other financial asset class, I guess you could say.
You brought up Polymarket there, and this was something I was curious about before our conversation. I haven't looked too closely into the types of contracts on these prediction markets that are related to the conflict in Iran, but I'm sure you have because of its implications in your industry. In general, how accurate of a forecast do these prediction markets tend to bring? Is there enough volume on them? And I guess more importantly, how do you think about them as a source of information, I guess, right now?
I think to begin with, it was great. I mean, it really was nothing like it. And actually, funnily enough, it was the Iranian situation last year. So I forget exactly which month, but it was very useful then because it was a new concept and a lot of people were betting on the Straits of Hormuz being closed. And it was just saying, will the Straits of Hormuz be closed? And, people have talked about the Straits of Hormuz being closed as a hypothetical. You put it in your scenario analysis and you talk about a hypothetical, but no one ever believed it. Well, one, that it was even possible, and two, that it would happen. And we even had a guy, one of our research guys, like just adamant, he's been in the game for 50 years. He's like, you cannot close the Straits. So it was really interesting to see people like actually believing that it would. And for a time in Polymarket, it was like for like. We were watching it live and it's going up to 80% yes. And we're like, come on, someone knows something. And then you get all these like messages of people saying, I'm literally on a ship in the Strait, it's fine. And that kind of thing, that transparency of information and that real lifetime, you can't beat it. And you can't, this is the good part of capitalism, right? Using people's greed for transparency for the better of functioning markets and functioning day of life. So, no one in any other way would be incentivized to tell you what's really going on. So suddenly you have something like Polymarket and someone has information and they want to trade it, that finds its way into the ecosystem of information. So I thought it was a really good thing to begin with. Then what started happening, unfortunately, is it started to get more and more popular. And then we started to realize that the way it's settled is just not ideal. So even with that Straits example, some people felt that it had technically closed. There was an announcement, there's ships had slowed down for a time. How do you define closed? So the settlement, and you know what, it's funny because in our market in particular, because there's so many of these contracts, the big thing in our market is to let these contracts expire, which is actually quite an unusual thing. We take a lot of us take these contracts to expiry, and you might hold things against it, but expiry is incredibly important. So how the contract expires and to what methodology is incredibly important. So we're very used to studying these underlying methodologies, and that's where maybe not arbitrage, but relative value opportunities can come. Very, very, very important. So when we're studying that from a Polymarket perspective, we lost confidence very quickly in what the game was all about. You have to own the tokens, I think, you have to own a big portion of it to be able to decide. So who decides is as important as anything else. And then it just I'm not even saying it's rigged. It's just inefficient. So to use it as a reliable source of information it kind of lost its gravitas quite quickly, to be honest with you. And so then we stopped looking at it. And actually, funny enough, what it then became was just the options trading. Like, options are a very interesting mechanism of trade, as everyone knows. But it's interesting that when someone has good information, and you can kind of empathize, right? If you have good information, you don't know when it's going to kick off. So you just want the straddle, or you want some good convexity. So an option is a great thing to use. But the interest in options just becomes so overwhelming that that's been a better indication of information being out there than anything else. So we kind of moved from Polymarket to the options open interest and options activity at key times right around the moment. And just to finish on that, the oil market historically has been quite orderly around its market hours. But after 7:30 p.m. our time, which is the market close, kind of US up to maybe like 6 p.m. their time, that market, that time's meant to be dead. It's meant to not really trade. And it's been very, very active around these times. So now we're doing the hours later on to say, let's see what's going on here, because the order book will reveal things. And if you've got the visibility of all the contracts, then that's where you're in the best position to know, has someone selected something in particular, and what could that possibly mean? Because there's no real way, there's no other reason why you would trade at that time. If you want to trade and do a hedge, then you know the peak times. If you want to trade and speculate, you want liquidity. So again, you're going to go for peak times. So why are you trading in these evening to nighttime trades? It makes no sense other than maybe you've just got the information. And I think Trump knows that as well, because he makes a lot of his announcements either on the weekend, when the market will then gap up or gap down, and at night. And we're forced to be very ready up until the actual close of the exchange now, rather than the close of the market day.
Real quick, how's your sleep been the past week?
Yeah, it's funny. It's been horrendous, but at the same time, like, it's so fun, right? As in, like, this is what it's like. Like a fighter pilot, right? Like, oh, are you okay? You've been flying your plane a lot. So yeah, I'm a fighter pilot. It feels like that. It's like, you certainly don't have any sympathy for us, right? We got the sleeping bags in the office, and we're in. But this is fun. This is what we do. This is the game. So it's not fun when you're losing money, of course, but to be engaged is a bit of a gift, to be honest. And I feel grateful. We get to see history in front of us and be involved in history. And sometimes I think people don't understand that, particularly the younger guys. I'm like, look, when we're trading on these screens, you do realize, like, this is setting the price of pretty much the world's economy. And every change in price is a huge impact on the world's economies, and certainly by region. So having an active involvement in that, especially in some of these niche contracts, kind of feels like a bit of a privilege, to be honest. You go and get asked questions, sure, from journalists or whatever, but even your friends and family, like, oh, oil's kicking off. They think, oh, who do I know in oil? Oh, my friend or whatever, my son or whatever is in the oil trading world. It's amazing how much attention you get. This is weird. It's like a niche part of the world with not that many traders in it, but disproportionately can have such a big influence in the global economy. And that's always fascinating to me. And so, yes, the sleep's been bad, but it's been fun.
What you said there about, though your sleep has been bad, it's a privilege to be able to participate in history in the making. I fully agree. And I can't imagine, from the perspective of someone like you who loves this game immensely. I mean, you live for this, right? This is what it's about. And I guess I want to zero in on what it's like in your shoes right now. Are you sleeping at the office?
I'm sitting in one of our offices. Yeah, we've got two. This is more the service arm, but the guys, actually still a few people, the reporters we have, they're getting information all the time, which, having a service area as well as trading, people find that unusual, but it's just because of our market visibility and all that, it's something great to leverage off the data, the information, recurring revenue for our business model. We can talk about that if you like. But anyway, they're doing that. So to your question, it's all about this WhatsApp these days. It's blaring all the time. You're forming camaraderie like you would be in battle. You're always talking and you're always engaged. And if you were losing money, which last year was a horrible year. We had a good first half of the year. Second half of the year was really tough. You're still talking, but you don't want to be there. Everything's a struggle. But we put the time in to get our risk management way like more locked up. We were very critical about pretty much everything we did and made some serious improvements. And then suddenly to have all those improvements to be ready for an event like this, it's
Wow.
been really, really great. And so to be in my shoes right now, again, has been just incredible, because you're able to look and say, God, what we've done this week and last 2 weeks is, yeah, as you said, it's the game, it's what we do, but it's the demonstration of what we've built. So that for me is genuinely, it's the peak of my career. I'm 36 years old. I'm not exactly an old guy, but I've been doing this for 13, 14 years. Built Onyx with my co-founder, Omar Khayyam. And to see in 10 years, it not really be about one trader, it's about all of us and the information from the service guys and the edge we have there, the data, the trading, the visibility, the internalization, the everything working together, the client flow. It's a real pleasure. But I think what you probably want to hear as well is being my position from a risk perspective. And I do think this probably an interesting point, which is, I don't mind being honest about this now, because I feel like the risk is potentially gone. But I suddenly got very worried yesterday. And it's one of those things, like, I'll go to my office, I'll walk around a bit, let things stew. And it's like, bang, shit. This reminds me of 2022 in the natural gas markets. Now, we're doing more and more natural gas, more and more power, but we've got a lot of growth to be big in those areas. But we were doing enough at the time to know what was going on. And it was an oil crisis, but it was way more of a gas crisis in 2022. And what happened in 2022 is the TTF, which is the European natural gas prices, went so berserk, like broken, a bit like almost like the oil market's doing now, but more, that the EU was starting to look to intervene. And they had their price caps at domestic level for the physical, fine, but they wanted to intervene in the exchange price. And that is so scary, because remember, a company like ours, and to be honest, like a fair number of companies, hold so many different types of contracts against themselves. So again, when I told you about the different methodologies, you study those methodologies as well as the correlations and the expiry mechanisms. So you're comfortable holding these things together. You're just so comfortable, and it's so well modeled that you don't even think about it. You just think, yeah, it's on my balance sheet, but I know my delta, my risk is pretty much zero. But an event like this, suddenly you go, shit, what if the mechanisms were just to break down? So to my point about the TTF, the European natural gas, if the Europeans, which they did say they were going to do, put in a price cap on the futures, then what happens is, if you hold futures against other contracts, what we usually do on expiry is buy back those futures like in an administrative way against the rest of these contracts. But suddenly, if they've got a price cap, no one's going to sell you the futures. So we were like, okay, so we could just lose $1 billion. But that's it. I mean, and then there's nothing we can do about it if they put it in. And we'd have to lobby, we'd have to panic and call the governments, but you can't do this. It was seriously concerning. And of course you're short. Of course you're short futures against all the rest of the stuff, You've always got the worst position. So I was very nervous at the time. It didn't happen. I think reason came over these guys. I think there was enough people explaining it. I know it's a long story, but the point is that yesterday I felt that way about oil, and it suddenly clicks. Are there some things that, regardless of the risk, because we've taken care of that really well, like the market risk, look, we're good. But what about the risk we can't control, which is the breakdown of the exchange mechanisms, the breakdown of the pricing mechanisms? What if that changes? So give you an example. You might have a contract against another contract that, typically speaking, you might do 100,000 barrels versus 100,000 barrels. But when you accumulate all these trades against all these trades, almost like pairs, right? But you do it in so I said 100,000 barrels, we probably have 50,000, 50 million barrels as opposed to 100,000 barrels of some of these things, because it's just the nature of the business. You accumulate all these things. So if that could possibly move 1 cent, you're talking 500 grand, right? If you're talking $200 oil and everything breaks down, maybe there's a $50 per barrel change. And now you're talking, it's just not even worth thinking about how much money that is. So of course it wouldn't just be so binary, it's done. But that's the worry, and that's why when governments talk about intervening in exchanges, it's like, be careful, because there's a whole dynamic and ecosystem at play here that requires liquidity providers, banks, and the rest of it to hold an enormous amount of risk. The best example is Treasury. The Treasury trade, you probably know this better than me. I'm not an expert, but how they've been very worried about the leverage hedge funds have about trading dollars against some of that arbitrage, and they just have such big leverage positions. It's a bit like the long-term capital management type stuff. But the long-term capital management stuff, that was real risk, right? But this is you. If you asked us, it's not real risk. It's expiry administrative volume, but that can suddenly become real risk if people decide to mess around. So that worried me. So what did I do? I was like, right, I need to get on top of this. So you go around and think, where are the actual risks? And to be honest with you, the market was really great. The market was, most of the time obviously has the opposing stuff that we have. So we just went and cleared up things that I felt that could be at risk from a very tail kind of mechanism scenario. And I feel a lot better about it now. But that's the kind of thing that, being in my seat, I've got to be responsible for offices, New York, London, Dubai, Singapore, and we've got 2 market making businesses that compete with each other. Diversified risk, that's a lot. Suddenly that becomes a pretty big burden if one of these things is going to suddenly break down.
Oh yeah. If government intervenes, the whole infrastructure is done. I mean, I get the exchanges you guys are not in a good position. Yeah. I guess we touched on what it's like being in your seat right now. You mentioned also earlier that you've been very happy to see to see yourself having built up this well-oiled machine and seeing it run, right? You're saying that has been an amazing part of this experience for you. Even though it is stressful, even though you're not sleeping very much. What are some of the highest value things that you did in building up the business that you think prepared you very well for a crisis like this?
So I think first things first, for the last 2 years, so we had a peak in 2022 of market conditions, and then 2023 was also good. But 24 and 25 were pretty horrendous. So I think countercyclical investment, I think, is very, very important. Because of course, everyone wants the top traders, everyone wants the best infrastructure whilst you're making money. And to some extent, we did that too. We've bought a couple of traders at effectively the highs, if you know what I mean. They came in, had good years in 2022. They came to us in 23, and they blew up 2024. We had an element of that. A couple of traders like that made our mistakes there. But when the market's in its lull period, and it can get pretty aggressively tough pretty quickly, and traders are traders, and sometimes it's very hard not to believe that you're the reason why you make money, right? So I think that traders believe that they were geniuses when they made a lot of money, and when they stopped being able to make money, there's a lot of existential crises going on. So you have to stay level-headed, okay, what is the process behind why these traders are good? So, and why we are good? What is our critical edge? We're not physical traders, we don't have physical oil, but we've got microstructure edge, we've got dark pool visibility edge, and you've got to go rely on that. So I guess to answer your question, it's countercyclical investment in traders. And when it was lulling, we had traders who we went out and bought. We actually bought a ton of traders from our competitor, and we had a big legal case during those 2 years. A lot of money spent, a lot of news about it in our game, and we set them up in Dubai. So we got that second market maker going, and it was quite painful from a cost perspective, but we believed in them, believed in the model, and got that going, and hired other traders. And the second thing is, well, kind of an extension of that, was getting traders from a coverage perspective. So again, if you're thinking about what your edge really is, and you're really truly thinking about that, well, if our edge is microstructure and visibility, then you need all the microstructure and visibility you can possibly get. So a New York office, a Dubai office, a proper Singapore office, and really trading those hours and having the proper traders in each region and the clients in each region became a big priority. So market share is a big statistic for us, but it's not just about doing trades for the sake of it. It's been having quality market share in all these areas so that you have the maximum visibility, and then obviously the maximum order book information and all the rest of it. So that investment cycle, 2 years while we're doing horrendously, well, not horrendously, just not as well for us, was probably the best thing we could have done. And on top of that, the funny thing is that our game is so opaque and different in the voice trading I was talking about, but it is still getting there, right? That we have our own platform. We have, given that we're fair value specialists in a market that struggles with fair value, people like our fair value. We sell data like that. We then get good relationships with clients. We've then built a very good client business. That, as I say, that's another thing which really comes in at the right time. So I just want to answer it like one more time, which is like not to disrespect any of our competitors or anyone else, but I think what we've been particularly good at is reflecting on what we are actually good at. And, I think the traders will admit this themselves, and I've certainly been here before, that whole thing about believing your own propaganda a bit, believing you're so good. And so when you're not doing well, how do you explain it? That's obviously a problem. But if you can explain it's not that deep when you make money, there's a process behind it, there's an edge behind it, then these are the guys that are going to do okay in bad times. And then when it's good again, they're positioned amazingly well and they're level-headed about it. So we kind of cleared out a few of the people who couldn't think like that. Actually, a couple of people fell on their swords themselves. A couple of people thought, I belong at a big place or whatever they want to say. And they went and did that. And the culture kind of reformation, if you like, especially last year, second half of last year, was a pivotal moment for us. And it's fantastic. I don't want to use the word relief because obviously you believed in it, but it's such a great feeling to see it all come together. And you never want a war, right? Honestly, people say, oh, you would say that. Of course you want war because opportunity. Look, it's not the right type of opportunity. It's crazy out there. You want like good market conditions. But we had to bring our guys that we just moved to Dubai, did all the administration there that took years, the setup. These guys were getting bombed, right? And we're trying to trade these markets. So we're like, what do we do here? We've got a humanitarian situation as well as the trading situation, as well as the risk situation. And actually, if you don't mind me keeping on rambling about the story, there was last Friday, things were really heating up and the guys were still in Dubai. They're actually over there. They've set up in this other office temporarily. We just made the call that we got to get them out there. So that's all well and good. Everyone's trying to get out. So we had to work with jet brokers and we had to fly ferry staff from Marseille to Jeddah, overnight Jeddah to Fujairah. Fujairah is outside Dubai. These guys are saying, you want us to come from Dubai to Fujairah, but Fujairah is getting bombed. It's a key oil storage area. We say, yeah, but it's an airport. We've looked at it. We had to change the flight paths like 5 times. Then everyone wanted their dogs. They've got families. So we ended up chartering like an Airbus with 55 people, 9 dogs, believe it or not, which all the paperwork and that kind of stuff. And people's families, they're scared, they're worried. But we pulled that together and got that done so that they were back on the Sunday and they were able to trade the next day. And that's a big relief for them, being away from that. But then, of course, you can get back to what you do. You've got to give it to them mental resilience. I mean, imagine you're getting bombed one day, you're in a 26-hour round trip the next day, and then the next day after that, you're trading again. But these guys have been heroes. And again, it's kind of all part of the story, right? And it brings you closer together.
Do you personally manage a book right now?
So I have a management book, we call it. Again, probably quite active in it last year. And as things are going badly or harder, it's kind of like getting in the trenches with your team a little bit, right? But I would argue that it's destroying, it's not reflective of what I just said about your true edge, microstructure, coverage, good risk management. Because at the end of the day, I'm not sitting in the seat, so it's effectively going to be a discretionary trade. So what I've moved away from is doing anything too active on that side. I do think it's useful to have a management book for actually hedging the company's risk. Sometimes it's very difficult for people to see how they're correlated across portfolios. So that's still got its use. But what it really made me think was actually the position I'm in, I should probably be leveraging what these guys don't have the time to leverage. So I've built a couple more teams to do different things. And I obviously don't want to talk too much about it because they're kind of in progress. And one of them's been very successful, which is like amazing to see. We've got future projects and this is what I can do in the meantime using my trading experience to kind of like build the next thing that we think will have a really good synergistic impact. But the final thing what I don't mind saying is, we've got more systematic. If we're going to take directional positions, we've got to use our edge. We've got to use our information. We've got to use what we are all about. But if we're going to take that into a proprietary position, it's got to be systematic. And that's going relatively well. And I think if that can perform and we can get a decent track record on that, we'll be looking to be, one of our projects will be to have a hedge fund as well. So that will be exciting. We've been asked to take money quite a few times, but really there's no point because, if we can do low capital, high reward trades and have this system completely privately funded, and we can build a valuation around it with data, services, liquidity, all the things that we're doing, then why would we need cash, or why would we want to take investor money to trade it? It's just going to destroy our returns. But if you can have a diversified set of trading that you wouldn't do in your core business, but it still plays to the same edge, I'm pretty excited about that. And I think the interest in oil and energy has been so great for so long, particularly the hedge funds, that I think it's something we need to do, because people are asking for it. There's good demand, and we should be doing it. So that's where I'm taking my kind of personal trading stance, I'd say.
Oh yeah, and especially after a time like this, I guarantee you the allocator is going to be like, "Hey, maybe we should chuck in a little bit in here. Wouldn't be
Yeah.
too bad. Wouldn't be too bad."
Well, only if you can diversify it, right? That's my key thing. I'm not, when I got offered money before, some people would say, just take the money, right? And then figure out how to do
Was
it,
it a
what
lot?
to
How
do
much
with
were
it.
you, well, was it a big chunk of cash?
Yeah, we didn't really get to that stage of this is what the number's going to be. To be honest with you, these funds have so much capital, so much cash they want to deploy in these areas, and energy in general is so underperforming as outside of, say, Citadel, the energy traders and hedge funds is seriously underperforming. So all the hedge funds want to be really good in that area. I don't know for sure, but the impression I got was the capital part is not the problem. It's the deployment and believing in what we're doing. And I think the story works, but I wasn't comfortable to say, okay, but you're going to be getting the story. You're going to be getting the results of the story. If we're a microstructure business and we have that information, we have that edge, then let me translate that into something I believe in myself, that I put my own money in, and then we can talk and we'll take the capital that we need. Because I've never wanted to do that, right? I mean, again, the capital raising is sometimes just a capital raising game. The more you get, the more management fee, it's a good income. But that's pointless for us, right? That's a lot of distraction and a lot of waste of time. We should be in the hedge fund space because it allows great scale and diversifies your trading, and it's new, and that's why I'm excited. But what's the point of getting a bad track record and a bad name just because you wanted to be a hedge fund guy, So that's kind of where I'm at with the thinking. But no, I mean, hopefully we'll be in a pretty decent spot at some point, touch wood, and who knows? But I just don't want to jinx it either, right? This is just something in the works.
What have the differences been in managing a book versus building up your own business? So when you started Onyx, what was that like, I guess? That real distinction between the two.
To begin with, just me and Omar, right? He traded gasoline, I traded crude, and it's what we did. So we were just back in the game, and it was about building teams around us, training, recruiting, that model, and that's what we stuck to. So really, I mean, to be honest with you, in our last place, that's what we did anyway. It was a startup, did amazingly well in 3 years. The owner kind of moved to Singapore, was a bit hands off. We felt like we were doing everything end to end, everything from speaking to the banks, to the reconciliations, through to the trades, through to the reconciliations again. So it wasn't really too much difference for us, because we're going from running that trading floor to running our own trading floor with investors. And so that was pretty normal for us. It's only when we started to consider, what are we actually trying to do here? 26 years old, it's great fun. But a couple of years in, no, I want to build something properly here, right? This is what we're here to do, something to advance this. And it was understanding that this market that we were in was growing incredibly fast, and that part was incredibly exciting. The exchanges hadn't listed these contracts before until we came in kind of 2012, 2013. So we were riding that wave, and I guess we hadn't fully appreciated what that wave was. And I don't think our previous boss, and I don't think our competitors have fully understood where they were positioned. They probably just thought they're geniuses. It's like, no, they were in a market whereby, with the exchanges now listing all these contracts, there's a wave of participants getting involved. There's a wave of transparency, which has this flywheel effect of virtuous cycle. Everyone, okay, more transparency, more confidence, more willing to put cash in, more participants, just again and again and again and again. So we're talking like monumental, like triple-digit growth for quite some time during that 10 years. And the bit that hit me was, we're market makers, proprietary trading element, but people kept saying, you'll never be able to sell that business. You'll never be able to create a valuation in that business. And that was kind of weird to me, because, I knew enough about the banks. I interned at a bank.
Just 1 second. Just curious, why did they say that? Why wouldn't that be a business you could put a valuation on?
Because at the end of the day, we were just a bunch of traders. There was only really, two of us, me and Omar. We hired juniors, trained them. And it did spiral from there. Then we hired a couple more, and suddenly we're a team of 15, then it's 30, then it's 60 now. So that happens. And I'd say now it's maybe not you couldn't say that. But at the time, it's pretty reasonable, right? At the end of the day, we left a place and they went down a few years ago. It took a while, but at the end of the day, if all you're doing is, if you're just as good as your traders, that's the critique. You're as good as your traders. But the mistake there was not understanding what role we were playing. So because it was so new, this asset class, so far behind all the asset classes, you could kind of look at the other asset classes with a lagged effect and be like, well, I'll just do what FX did 10 years ago. You know what I mean? We'll create our own single dealer platforms. We'll have our own data. And I guess the amazing thing about that position was we were doing so much of the trade. So we were the biggest brokerage payers. You know, you can check our accounts. There's no point in me not saying, you know, $80 million in a year paying brokers, exchanges, 50, 60 million. And then when you go out with them, you're kind of treated like it's not a customer relationship, like you should be grateful type thing. It's a very strange thing about oil in the past. I just couldn't get my head around it. So I was like, this is, okay, so we can't get a valuation with traders, but we're doing all these trades and paying people and making people's livelihoods. So how do you figure this out? And I guess it was understanding that this market was on this trajectory. And because we were doing so much of the trading and because we were such a big market share, there must be power in that data. So there's power in understanding the markets and maybe, you know, research element of that. We even had we have training academies that we sell. It was just trying to find things we could sell with our knowledge and understanding that wouldn't deteriorate our edge. And because even things like positioning, very useful. You can put trades off the back of it, but just selling our position and selling what the market has been doing with us, you know, it's incredibly useful information, and you can package it up, you can make it look nice. And I think that's great information for the market. And it's not like a huge edge for us to have it. And so we might as well make recurring revenue out of it and then create a kind of valuation off the back of it. So suddenly those kind of things became more and more of a concept. And then you just keep going, right? You say, okay, so we've got all the liquidity, let's be the best at this. And then pretty sure we were confident that we were the biggest in the world, verified it, looked at the numbers. Okay, we are the biggest in the world. So, you know, Peter Thiel says that, right? Like, just you've got to do something that you can be the best in the world at, right? And so there's that, right? You know, we were called a small prop shop. Now we're the largest liquidity providers in the world in oil. It's like, fucking hell, who are these guys? And it was true. And so, you know, you got articles about it. And when they asked the community, people were like, yeah, that's probably true, but so what type thing. But to any other asset class, people understand, yeah, that's a big role you're playing. It's like market infrastructure. So it's okay, so you've got the liquidity, you're the best price, you're selling data, you're selling training. Okay, what about a platform with your fair value or visibility so we can know where the market is in this, you know, big ecosystem that's so opaque? Okay, how about some of that? And then it's like, well, now you're a marketplace. What about offering market access? So now we've got a retail brokerage, right? We actually offer retail into these markets. Very early days, and people, you know, it's just so foreign, this market. But events like now will obviously change that. So now we have client relationships with, you know, physical trade houses who want our credit. You know, we offer them credit to trade with us. So they get our prices and we loan them money to be able to do it in effect. So that's, you know, a kind of mini bank type model. That's growing very rapidly. And as I said, it's all about leveraging off your core engine. So other companies, you know, they might be a brokerage and they say, now we want to be a clearing brokerage, you know, offer market access, but they always have to go to the market to get the liquidity. Well, I started with the reverse. Why don't we are the liquidity. Let's build the other way around, because that's efficient markets. And I was in China not long ago, in January actually, and spoke with a lot of these Chinese brokerages. They don't understand what an interdealer broker is. An interdealer broker for us is someone who picks up the phone at BP and says, okay, would you buy? And the other broker picks up the phone to Shell and says, would you sell? And they negotiate. That's the job, and there's a commission. To anyone else, or these Chinese, the broker is considered someone who actually takes the risk. They take the position on, they deal it out, but they're ultimately holding it on their balance sheet. They have to owe credit. That's a broker in their mind. And these guys all say, we're market makers, we're proprietary traders, and we're clearers. And there's 4 or 5 huge ones in China, particularly in commodities, and there might be others, but these guys dominate. So again, it's re-emphasizing that the efficient model is our model. So we've been watching other companies take all this fat and not even have the last price, the most liquid price. So it shouldn't be hard for us to reverse it and say, well, if we're the best price and you're coming to us anyway, why don't we just offer these things that they're offering? And it's going to be undercut and it's going to be synergistic. And if you bring it all together into a group and you have streamlined the operations around it, then that's a very good business model. It's almost like you're acquiring businesses and bringing them together into a central operation, except we're not acquiring, we're just building them ourselves. And every single time we do it, it doesn't feel like a new business. It feels just like an extension. So people say, how can you have research? How can you have media? How can you have credit? How can you have retail? Because they're all really the same thing. Talking about our market, visibility of our market, and accessing our market. It's just offerings that allow that to happen. And that's what's born this model. So 10 years later, as I say, all of this coming together, no one could accuse us of not having a valuation now, right? And we have had offers, we have had people talk about investing, but why would we want investors? They're just going to come in. We had horrific investors when we started, and we bought them out with our own money, with dividend money. We made them something like 2,000% with dividends included and share buybacks, and it does strain your balance sheet, but it's so worth it because suddenly you got no more questions, no more crap, no more like just endless board meetings and silly management things. Like we had people who didn't really understand our market come in and say, "Oh, Greg, I'm watching you trade. Are you losing money?" I'm like, "Yeah, I'm losing a bit." I said, "Okay, don't lose any more." And oh, cheers. Do you know what I mean? Like what the hell is that? Do you know what I mean? Like, so to get that out of the way and then drive your decision making with this very, very particular mission with no distractions and your own money is fantastic. It's the best thing. And I can't bring myself to say, let's get an investor in to come and screw that up, unless they're very, very particular and they're very, very good. But look, we've had board members as well to try and get this kind of thing going from potentially investor scenarios and things like that. But to be honest with you, again, I mean, we're not that young now, but like over the years, it's this kind of condescending, well, you tell me what you're working on and I'll tell you what I think of it. I'm like, no, I don't need that. I need someone to, I've got the connections, I've got the, like, how can I help? And recently, to be honest with you, like the recent board member in particular, has been so unbelievably good. Like you're talking about a guy who's like, oh, okay, I get what you're trying to do. All right, cool. So this is how this would work. This is how this would work. You got any questions? Yeah, how would this would? Okay, yeah, bam, 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 bam. Cool. Pick up the phone anytime you need to discuss it. Oh, you want to hire this person? Oh, okay. Well, I've got these 3 people I used to work with. They're great. Do you want me to reach out? Yeah, great. I mean, it's just been unbelievable. That's what a proper board member is. But just to my point, like having an investor now, like in the classic sense, someone who's like holding you to the fire, like when are you going to make money? We just don't need it, right? Like, so that's, yeah.
That's amazing. I just finished reading, it's somewhat related. I just finished reading Shoe Dog by Phil Knight, the book about building up Nike. And
Yeah.
I think with young people today, there is this notion that if you don't have everything figured out by the moment you graduate university, it's over for you. You should have had your internship planned and then your grad scheme and then your whole career planned out, where if it's in, let's say as a trader, it's trader or a quant or PM, or running your own book, whatever. And then after that, launching your fund, or partner, whatever that may be. But it seems like for you launched the business initially just doing what you're doing at your previous firm. And then there were all these different moments where it just started clicking.
Yeah.
Is that how it played out? Or did you have a master plan from the start? Or was it little by little, you're like, hey, hold on a second, we can do this media thing on the side as well? And then walk me through that.
Yeah. No, it's kind of both, because I can't give myself too much credit. It's one of those ones where, as I said, in the 1990s and early 2000s, the banks ruled the game of oil and energy. So my brother worked at a bank, BNP Paribas. I'd seen that intern, it got exposure, but they started to pull out because of the Volcker rule and the financial crisis. So by 2012, they were kind of out and there was this vacuum and there was this scenario, but we knew enough about them and how they ruled the game that there was a playbook, if you like. So I would say that was, if we take J. Aaron, for example, the Goldman Sachs, they bought J. Aaron, and then a lot of the J. Aaron people became top people at Goldman's, and Goldman's senior people, a lot of them are commodities. A lot of people say that. So we were aware of that story. I was very aware of that story. There's a guy like Dick Bronx, who was huge in oil. He actually did a bit of work with us actually at early stages. And I had a lot of admiration for how they didn't just stop at trading. They obviously got the clients and the financing, but they built indexes, the Goldman Sachs index. They had obviously their investment management. They pulled a lot of things together to create a flywheel. So I knew that. and I knew that they were now having to pull out and just couldn't really be in the game in the same way. And then I also knew that the market was evolving beyond kind of what they were comfortable with. And no offense to Goldman, but they're so big, they look at a niche market and go, it's just not worth our time, But so we did the opposite, like just zeroed in, completely quadrupled down on this expertise. I guess in a way taking a gamble that this market was going to be something huge. And how can it not, right? I mean, it affects everyone in the world. How can oil and energy not be as financialized as FX? 8 billion people use energy. FX, maybe 1 billion people use. So how can the financial markets not be huge? So that didn't feel like a gamble, but that was it. So yeah, in a way, a bit of a master plan to say, right, we're now the liquidity providers. We've taken over from Goldman's. We've taken over from the banks. Let's start building these arms. I didn't actually think we'd ever get to the credit and financing and stuff that we're now planning now, where you become a big corporate. That's been amazing. But I would say that wasn't part of the plan. It was just to really become the kind of like the market type vibe. And the great thing is that you could also look at the other asset classes and see all the innovations in front of you. So again, as I say, single dealer platforms for equities, for FX is standard. I mean, we're the first ones to have a proper single dealer platform in the whole market. It's crazy to think that, but that's the truth. So you can kind of lend or borrow off these innovations to then deploy them in yours, business models, technology and the like. And then I think what did start to click was, again, the guys in the oil industry, some of them are incredibly bright, but they're making a lot of money. They don't tend to care about some of the niche things. So what I'm saying is we could start to see that some of these innovations could be made that were incredibly, almost seeming like they're not that interesting, but we knew they would become interesting. And that was a really pleasant surprise to be like, well, what if we offered data? Well, what if we offered this? And as that started to come together, it started to like compound into this, like now we can have a master plan I never really considered before. And that started to get me more and more excited. And then the story started to kind of feed itself, because I only ever started doing the media because we got a bad Glassdoor review. Now, Glassdoor is a waste of time, right? It's literally every single time we fire someone or they leave, someone comes up with a story. Like some of them are crazy, like crazy stories. But when you're young, especially 20s, it gets to you, right? Like, this is my business, and the only thing you can find online is a Glassdoor review. So right, that's it. Like if they're going to tell my story, I get to tell my story. It's like Hamilton, right? You can't you can't control who lives, who dies, or who tells your story. Like, fuck that. I'm going to tell our story. So LinkedIn at the time was actually, eight or so years ago, wasn't that big for the industry, at least. So I was the first one to start doing presentations. Everyone's laughing at me. You're an idiot. What are you doing? It's embarrassing. But you follow through, and that whole influencer Gary Vee stuff was like, you listen to Gary Vee to get inspiration, and he's like, keep going, man, keep going. So that was really working. So we're getting a lot of visibility. This whole tagline of largest liquidity provider in the world that I put in place, that was starting to really feed back. So your visibility was working in a bigger brand. People wanted to join you. People were excited internally. And before you know it, you bring all that, what I've just said together, not a master plan, but an idea of how it's worked before, an idea of how other industries have innovated, now your brand, and suddenly it started to form itself into like, nah, this is becoming real now. And as soon as the other things that I did other than trading started to actually make money and actually have value, that's when it's compounding now at such an amazing rate. And there's all these quotes out there, right? Like, work on something for 10 years, and then you'll have overnight success. The idea being like, it seems like, you guys came out of nowhere. It's like, nah, man, we've been compounding every lane for so long now. And I've got to say, being laughed at a million times, being ridiculed, people not wanting to take our side, because we're disrupting an industry. Like I said a while back, there's a lot of brokerages, for example, a lot of people making a lot of money the easy way, if you like, through opaqueness and through select relationships that are protected. As soon as you open it up with transparency, data, visibility, our journalists, pricing, trying to do our own contracts, it's all these things. They're like, you're getting in the way. This is $100 billion a year business. Stop doing this shit. Let's keep it the way it is. But that's just not the way the world works, right? If it's not us, it will be someone else. And the market's getting more and more and more efficient. So now I don't find it as much. People are like, that whole first they ignore you, then they laugh at you. then they fight you, then they join you. So I would say we're like kind of at the cusp of fight and join. And we're getting more reliable customers, and the industry's starting to accept that it's changing, and they're going to have to just put up with it and find a way to evolve with it. And that's kind of where we are now.
Super exciting. Gosh. And I relate to you saying you got to be laughed at. I'm not saying I've achieved any level of success, but even just starting this podcast, I'm actually very grateful that I I'm sure people have laughed at me, just from the start. You start anything new, some guy who you knew from high school, whatever, he's probably going to judge, right? Obviously it's part of it, but I'm very grateful that I didn't actually see that, if that makes sense. I think it's different from the Glassdoor stuff where you see it, it's your baby, this is your company, this is your baby, you're building it up, and you see it, and that definitely, I can understand that having a big effect on you. And I guess just last thing before we close, what has been the single biggest thing that surprised you along this journey? I mean, we started the conversation talking about what's happening in the oil markets now, the crisis, but now we're talking about your business. What surprised you the most?
I think to not be too deep and philosophical about it, it's the consistency of how important values are. So you have a gut feel when you're growing up, don't you? That what is the right thing, and you could get moralistic, and I think that's dangerous because one person's good is another person's bad, and so on. But raw ingredient values, things like we started to label, resilience, humility, accountability. And to your point about getting laughed at, the reason why you don't is because you're humble, and I'm 100% sure about that. And humility is about learning from people, willing to listen and be a better person every day. And that's a Stoic principle. And I think that those guiding values are just so incredibly important. But I keep getting surprised at just how much it always comes back to that with every single thing we do. Every single time we hire someone and do a new project, it doesn't quite work out, or doesn't work out the way you want to, or you need to let go of someone, and you realize because there wasn't the raw ingredients. And look, there's no shortcuts. I've got to do this myself. I've got to understand it myself, or we've got to understand it ourselves, and we've got to do this properly. There's no shortcuts. And some of the most complex things I would have thought that's incredibly complex, we're never going to be able to do it. But just resilience, humility, accountability to keep cracking on and every day turning up and trying in whatever field it is, it will compound and it will result in high performance and it will result in success. I sometimes ashamed at myself of forgetting that because it keeps revealing itself year in after year out. And again, it's hard for even people internally. If we lose someone who maybe might have been popular, they don't like what the business is doing, and they leave, and you start to, what's really going on? So, well, if you keep going and keep staying true to what you are, another principle, right? And as long as you're not being ridiculous, as long as you're not doing something evidently wrong, if you've got a clear plan and it's a good plan and you stick to it, these things do tend to figure themselves out. And then you realize later on, and people realize later on, it's probably a good thing they went, because they were never really into this, and they never really respected you or respected us, or they never really, they had their own personal problems, or whatever it might be, or the project just maybe wasn't quite what it should have been. It should have been this, whatever it is. And there's just never, ever going to be a substitution to self-reflection, humility, and just grinding and iterating it out. Even the most, as I said, the board member who I'm a very big fan of, he's got to leave us at some point soon this year. He would turn something that should be incredibly complex, saying, look, just calm down. You've got the right principles. You've got a structural edge in this. Just start the process and do it every day and turn up. And as long as you overlay those principles of hard work and iteration and whatever else, then it will come. And the only reason it won't will be is because something fundamentally is missing. And look, maybe it might be competence, maybe it might be something structural, but you've got to know before you go into it, am I clever enough? Do we have the edge? Do we have the money? Do whatever? And as long as you're sensible about those things, nothing is unachievable. And we're in that world, aren't we, where we think, AI and all these things, like everything's moving so fast. How am I going to be able to keep up? Like, it's just over. I might as well just, God, I've got to find something else to do, or we should just stick to this. No, for everyone, no one's got their shit together, right? Everyone is trying to keep progressing, and everyone's scared of everyone else. You've just got to stay true to yourself and keep going. So I hope that's a good answer, because that is honestly what I think is the most surprising thing to me, but the most important thing to me now.
Everyone's scared. Just keep going. I love that. Thank you so much for coming on the pod, Greg.
Thank you so much. A great interviewer. I hope to hear from you soon.